Recording
Gentlemen,
in
and welcome to
progress.
Siloam First Half 2024 Earnings Webinar. We hope everyone is doing well. My name is Willie Chandra, and in today's webinar, I'm joined by Ms. Karen Reddy, Siloam's Managing Director, and Mr. Daniel Phua, Siloam's Group CFO. This webinar will be delivered by Mr. Daniel Phua first, and followed by Ms. Karen Reddy for business updates. After the delivery, we will open up the floor for Q&A. For participants who want to ask questions, please use the Q&A function in your Zoom screen. And without further ado, I will pass on the floor to Pak Daniel for financial update.
Thank you, Willie. Good morning, everyone. Thank you for your continuous support. I will start by going through the financial and operational results for Siloam for the first half of 2024 and Q2 of 2024 as well. If we can go to the next slide. So 2024, I think, is very important because I think is the first year whereby when we look at the year-on-year growth, it is a year whereby we are not affected by any kind of effect from COVID. And basically, 2023 first half was not affected by COVID, and 2024 was obviously not COVID related as well. So when you look at 23 to 24 growth and improvement, it really demonstrates, I guess, the stable performance capability of Siloam. I think in the past, quite a few of you have always asked me as to say, look, the improvement, is it a lot of it coming up for pent-up demand and so forth? I think we're safe to say from 24 to 23, there really isn't any factors of COVID still lingering. And this really generally shows the operational improvement and excellence that has been made by Siloam over the years. As you can see from the result on your screen, revenue for first half basically stands at 4.66 trillion. This is an improvement of 14% compared to last year. Underlying EBITDA, again, I remind the audience, the concept of the underlying EBITDA was the fact that we removed the effect of the one-off adjustment in Q1 of about 308 B. Again, I've explained that previously to you, and that is basically related to a lot of the hospitals that we've decided basically not to go ahead, and therefore we're writing down the underlying constructions in progress value. So if we look at underlying EBITDA, which is really the operational performance of the hospitals, the underlying EBITDA is 1.39 trillion, an improvement of 15.3%, compared to last year. EBITDA margins remain stable at around 30%. Underlying net profit, similarly, that is improved by 25%, to end at 644 B for one half of 24. NPAT margin sits at 13.8% compared to 12.6% the year before. Now, if you look at quarter performances, you will see that 2Q24 is relatively flat compared to 1Q24, and in a sense that's expected. 2Q24 seasonally has always been the slowest quarter, primarily due to Lebaran. You also have the Idul Adha that fall in the same period as the school holiday, which means that a lot of our doctors went on holiday and Hajj during that time. So typically, when I shared with you before previously on this concept of a productive days that we use internally. So if we were to look at the idea of a productive days, 2Q24 is usually about 5% less productive compared to 1Q24. Again, you have seen in past trend, usually the third Q and fourth Q is more productive. Third Q and fourth Q is usually about 2% more productive compared to first Q of 24. So traditionally, 2Q24 has always been the slowest quarters, and it's about 5% less productive, as I mentioned. But despite that, as you can see, quarterly revenue remains largely flat for 2Q24. EBITDA, again, relatively flat. Margins for 2Q24 went up slightly due to some slight adjustment in some rental rate and some of the expenses that we incurred for the purpose of doing research and planning our next phase of growth. But by and large, the operational EBITDA margin is stable. As a result, as you can see, net profit has also continued its stable trajectory, and we see a CAGR since 2Q22 of about 13.7%. Look, the growth in the Siloam's revenue, as always, we have shared this previously as well, is anchored by our ongoing strategy to improve revenue intensity. Next, please. Again. You will notice that the average revenue per occupied bed, 2Q23 to 2Q24, continue to grow by about 3.5%. Yeah. Similarly, we've seen growth in the average revenue per patient days as well. But 2Q to 1Q24, you will see that similarly we have grown by about 1.1% in the ARPOB and 1.4% in average revenue per patient days. I think Carol would share with you later on some of the initiatives that is ongoing for us to continue on these strategies to basically increase the revenue intensity and increase the complexities of the service offering that we are providing to our patients. And that has, as you can see, anchored a lot of our growth over the past 2 years. In addition to the improvement in the ARPOB, you will notice that the throughput has also improved steadily compared to what we've been doing previously. The quarterly results shows that the inpatient admissions, it's improved by about 13.9% year on year. And the inpatient days is improved by 12.8%. Occupancy rate remains stable, and outpatients has improved by 11.8%. So the growth from Siloam is basically coming both from the improvement in revenue intensity and also improvement in throughput. Obviously, if you compare 2Q to 1Q, performances is relatively flat. As I alluded to before, that is largely due to the seasonal factors of Lebaran and 2Q being typically a slower month. Moving on to payer mix. Payer mix has remained stable as well, but the corporate insurance mix has improved slightly from 49.6% to 50%. You will see that in terms of Q on Q growth, both private and BPJS has improved by about 14%. So nothing much to differentiate them in this quarter. But I think that is on the whole commendable. Most of you understand that, especially in the insurance market, things have been challenging due to the rates and so forth, but we've been able to still maintain the same level of growth in the past. And I think in 1Q, I've also alluded to the fact that BPJS in 1Q was growing faster than the corporate insurance. In one half, as you can see, things have balanced itself out, which basically means that in 2Q itself, the corporate insurance market was growing slightly higher compared to BPJS. So I think we're likely to see this trend continue, that the mix should stay largely at the kind of this 50% mark that you're seeing right now. In terms of EBITDA margin has been relatively stable. Again, underlying EBITDA margin I'm referring to here, which is excluding that 308B write-off, the write-down that we conducted in Q1. If you look at things like the key metrics we monitor, drugs and clinical supplies, material costs as a percentage of revenue has steadily come down as well. 1H24 sits at 27.9%. Compared to 1H23 of 28.8%. Yeah, compared to 2H23, it is also lower. Operating expenses remain largely flat. I alluded to before there were some rental adjustments, but by and large, it has not moved significantly. But as a result, due to the slower quarters and so forth, underlying EBITDA margin is down slightly, but I think I would call this stable at around 30%, which is kind of the margins that we said we want to maintain at. Underlying net profit margins, therefore, close at about 13.8%, an improvement compared to the 12.6% we were booking in the 1H23. From that, if we were to look at the working capital days, I would say that is stable. You see that there has obviously been substantial improvement since 2021. We now sit at, largely, generally, the 10 days. Is move up slightly in 1H24 due to some timing factors, but we have seen that coming down towards July as well. As a result, operating cash flow is strong at 912B, in line with the growth in EBITDA that you are seeing year on year. So that's all from me from a financial perspective. I would pass the time over to Carol for the update on the businesses. Carol, over to you.
Thank you. Daniel, for the update. Good morning, Bapak Ibu. I hope everybody is well. Let's move on to the first slide, Pak Willy. It has been an incredible start to the year. We are so proud of our teams and the way they care for our patients and bring healing. And our teams have worked very hard to push through to the execution of the last year of the Siloam 5.0 strategy, delivering our first half numbers. Now, I'd like to highlight several things on the slide before we go onto other things. The first is we're so proud that MRCC has received recognition from Newsweek as a top specialist center in Asia Pacific for oncology. It is the second year in a row that we have received this recognition, and we have climbed the list as well. This is a strong model for our premium specialist hospitals that we are also building in other craft groups as well. The second one is a recognition for two systems that we have implemented in our network. The first one is SOFAS, which is short for Siloam Online Feedback Aggregator System, and our Digital Express Lane system. These are two systems that have been game changers in our outpatient operations and transformations, and an example of one of the ways that we are creating a seamless online to offline experience for our patients. We continue to upgrade our facilities to support clinical programs and our patient experience. This is one of the examples where we are doing so. And this one is an installation of Linac and Cath Lab in one of our hospitals, Agora, which is in Cempaka Putih, and also an upgrade of our executive clinic in Siloam Denpasar to become a one-stop services. We continue to hold our clinical summits, which does a few things really. The first thing is it lifts the clinical capability in our network. The second one is fostering multidisciplinary approach to medicine, which is really the best practice. And third, to build a referral network to our centers of excellences. So these are some highlights, again, consistent with our strategy of the past few years and consistent with the messaging and the numbers that Daniel has shown, really focusing on growing clinical capability, improving patient experience to also increase the revenue intensity through these initiatives as well. Next slide, please, Willie. As a result, we do grow our clinical capabilities from year to year, which is also driving our top line. Now, we have been deliberate in focusing on 5 top specialties that we have shortened to CONGO, which is cardiology, oncology, neurology, gastroenterology, and orthopedics. Why? Because we believe that these are craft groups where Siloam is strong. We do lead in the market in these craft groups, and it is an opportunity for us to move the needle on clinical acuity. Now, within Congo, we are focused even more on several needle mover programs within the 5 Congos itself, because cardiology in Lubuk Linggau will look very different to a cardiology in, for say, Lubuk Village. So while we are uplifting Congo as a network, we want to make sure that we focus on a few centers that are already strong in its respective specialties, but has the ability to develop further through adoption of new technologies, new procedures, new diagnostics, et cetera, et cetera. What this does is it opens up access to certain services that is not commonly available in Indonesia, and therefore retains patients in Indonesia. It uplifts our clinical acuity within the network, and it also supports our clinicians with exceptional skills who have aspirations to build centers on a global level. Now, a few examples of this. For example, one is our advanced endoscopy project in Siloam Kebonjeruk. Gastroenterology has been a craft that has been developing over the past few years. We do a lot of basic endoscopy in Siloam Kebonjeruk, and recently we're moving into more advanced endoscopic procedures such as the endoscopic ultrasound, the ERCP, and procedures of the like. So we are converting a lot of those patients to advanced endoscopy and also strengthening the team. Another example is in MRCC, where we have a lot of lung cancer volume. We have several great lung oncologists there. Dr. Haryadi, the lung surgeon. We've been developing FATS, which is a minimal invasive procedure for lung cancer, which obviously gives patients better outcome, but also increases the level of clinical acuity, and of course, also the RPOB, which Daniel was alluding to. We also just got news this morning that the license for our second PET scan in MRCC has finally been issued by Bapeten. And so starting from tomorrow, we will be operating 2 PET scans in MRCC, which is a big deal in a country that only has 4 PET scans. So focused in centers that have that capability to go to the next level. So these programs and also the key Congo centers focus areas is driving the overall consolidated growth, as you can see, because consolidated, these focus areas are delivering 14% year on year, which is a higher growth than the consolidated Siloam. And as a result, we see a shift in the Congo contribution in the first half of the year from 39% to 40%, and we expect this to grow even more. Next slide, Willie. As we grow in volume and scale, there are opportunities for us to continue to optimize our performance. We are doing this there are a lot of initiatives going, but mainly we are optimizing performance through a few things. One, we are consolidating demand and consumption patterns. So standardizations of the drugs and the consumables and the stents and the cath lab consumables and the vendors that we use. This gives us a few things. It allows us to work with a handful of vendors instead of a lot of vendors, which means there should be better consistency in services. We are able to streamline our processes. And of course, number 2, then we're able to bulk our renegotiations as we grow and scale. And of course, number 3 is, as we're able to renegotiate, we need to make sure that there's compliance across our units to the price that we have negotiated, which is why the last initiative, purchase price compliance, which we are able to do with our systems to make sure that we are executing on what we have negotiated. And so this is resulting in the improvement in material costs year in year and also throughout the months. Next slide, please. I would like to continue to give you updates on where we are spending our money and where we are investing. So 2 main categories. First is investments. These are not new locations, but it is where we are investing, where the business has further potential to grow. Now, I've shared with you a few of these in the previous earnings call. There's Makassar, there's the Lippo Village Oncology Center, there's the Siloam Gubeng that we should be operating late this year, early next year. The new one to this is the ASRI Extension. Now, as you know, ASRI is our transplant center. It is the largest private transplant center currently, and we are running out of space. And we've had the opportunity to acquire land right next to it, and this allows us to increase capacity in that hospital that is growing and doing very well. The next category is new greenfields. As per guidance that we have given before, we would like to expand at 1 to 2 new sites in a year. We have shared with you our plans on Surabaya Chito, Surabaya Manyar, which we have renamed to Mer, which is more consistent given the location where it is. We've also shared on Kemang. I think this might be the first time we are sharing on 2 new other projects that we have started. The first one is Semarang Srondo. Now, we know that Semarang is a very promising market, We see upside from operating a larger, more comprehensive facility than the one we currently operate. We have started construction and we will complete and operate next year. The second one that you may be hearing for the first time is in Samarinda. We used to operate in Samarinda due to building issues. We were forced to suspend our services in Samarinda. There's been an opportunity for us to reopen in Samarinda, which we're very excited about. This will be a very nice 100-bed facility with focus in 2 to 3 COEs to create access to services in the region that is not currently available. We plan to start operating that in 2026. Currently, we have started construction in Samarinda. Touching a little bit on our digital, I think is important because our digital will continue to be a backbone for our operations, as well as bringing in new footfall into our business and engaging patients for longer after and before they come into our facilities. I've already mentioned sofas and the digital express lane. Again, this is one way how we're creating a seamless online to offline experience. And at the end of the day, whatever we do digitally has to be felt by the patients. So the last thing we want to do is to fall in love with our digital projects and our digital solutions, but digital has to then touch the patients. Now, digital allows us to hear directly from patients, and which is why SOFAS is very important to us. We continue to upgrade our system with technology enhancement. The last is experimenting with AI in the area of outpatient. I think that my CTO will not like me to share yet, but it's a very exciting project and it will be the first of its kind. And when it is ready, we definitely will be sharing with you. I think you will be equally as excited. But other than that, we are continually upgrading our EMR, bridging with BPJS, upgrading our patient portal, our medical records online booking for medical checkup, home care, lab, radiology, et cetera, et cetera. We are also strengthening patient channels to create stickiness to our patients. We don't want to give patients any reason to have to go elsewhere to get information or to access their needs. We currently have developed our patient channels. We have over 200 monthly active users from our My Siloam app. We have over 12 million web traffic for our website. A lot of it is through development of features and putting more content on our platforms. And therefore, it is mainly the majority, not traffic that we buy. So it is sustainable traffic that does convert into our facilities. Next slide. I'd like to share this slide with you because I'm very excited about some of our associates who have joined us. And I've also shared here a brief summary. I'm not going to go through one by one on the experiences and expertise that each of these associates bring as they come to Siloam. We are bringing the best from other industries and other markets. I don't believe that we should be closed. I think that we should be open and learning from other industries and learning from other markets. And whenever there is an opportunity, we do like to bring other people that have expertise that we currently don't have. And so the people who have joined us represent a wide range of industries and also global multinational companies as well. Next. A little bit about ESG, which I touched on the last earning calls. ESG is important for us because while we are doing very well as a business, we want to make sure we also do right and we also do good as well. We have put a lot of effort into strengthening governance over the past 5 to 7 years. And this has contributed to our ESG. But there are other areas that we should be watching as well. Now, the first step that we have taken is to do a materiality topic assessment to understand what our stakeholders feel are important for us to focus on. Based on that, we have shortlisted our materiality topics to, I want to say 10, to about 10 topics, which is largely in line to Indonesia's SDG roadmap. Let me take you through a few of these. Next slide. So we have arranged our materiality topics into 4 pillars. So we have our caring for our patients pillar, caring for our environment, caring for our communities, and caring for our people. Now, each of these pillars will have materiality topics under them based on our survey and our assessment. Each of them will have measurements. Each of them will have targets for the next 2 to 3 years. And each of them will have a roadmap and initiatives that we track periodically. Next. So first pillar, care for patients. 2 areas. As we continue to digitize, we know that data protection is on everybody's mind. We want to make sure that not only are patients safe when they come to our hospitals, but their data and their privacy is protected while they access care with us as well. The second one is in our net promoter score. SOFAS has allowed us to track our net promoter score completely digitally end to end. When patients leave the hospital, they're able to give feedback to us that gets pushed to a system. It is compiled, it is categorized, and it is sent to relevant departments and heads. It is important for us to be able to track what patients say about us, and we do analyze this religiously every month. Next. Hospitals consume a lot of energy and generate a lot of waste. Now, when we are able to use less energy and to generate less, then it is also a savings to us as well. And then we also reduce our carbon footprint. So these are some of the initiatives that we have executed over the past few months, and some of the savings that we have started to benefit from the initiatives that we are rolling out. So we will be tracking electricity use, and we will also be tracking water use as well over the next few years. And we will be able to show you how our consumption will be more efficient from year to year. Next. The 12,000 people across our network are the people who make the dream. If we take care of our 12,000 people, then they will be able to take better care of our patients. We have a long list of matrices that we measure on employee well-being, that we track from month to month. Whistleblowing process is also part of our governance process, and we do respond to this, and it does get reported to our audit committee and to our BOD, BOC as well. And our last is our community. We want to make sure that we are also going to great lengths to taking care of our community. So you have all heard about our Selangkah program. We are continuing our Selangkah program this year. So our target for our 2 years will be 50,000 women screened through our Selangkah program. If you have any interest in the breast cancer screening program that we are running, please contact our investor relations, and we'll be able to put you in touch with the right people. We continue our Papua Clinic program. We are now 7 clinics and 7 villages, and we have served more than 15,000 patients. We also continue to partner and provide scholarships through our nursing faculty program and through our medical facility. And this is win for both ways. We're able to provide schooling opportunities for those who would not have had an opportunity, but they then also become our pipeline, and creating better sustainability for our operations as well. And so that ends the ESG portion of my update, which also ends the business update from me. So I will be sending it back to Willie for a question and answer. Thank you, everybody, for listening and supporting Siloam.
Sure. Thank you, Bu Carol and Pak Daniel, for your time. We will start to open the Q&A section. Kind reminder for participants who want to ask questions, please use the Q&A function in your Zoom screen, and we will, so we can read the question from you. We'll start with the first one from the chat box, Bu. Question from Benjamin Ng. Recently, there has been a change in shareholding of Siloam. Are we expect more changes in shareholding, and how will the board and management team change?
Maybe I'll take this one again.
I was anticipating questions around this. So what I can say is, and then Daniel can ask, but there have been tender documents that have been circulated. We would not be able to disclose anything outside of the formal documents that have been shared anyways. So I encourage all of you to refer to the tender documents. And if you have any questions, you can email Willie, and encourage you to address all your questions to the relevant parties. But if there are other questions around business and performance, that is mainly why we're here to answer your questions. Daniel, you have anything to add?
Yeah, maybe if I can just add, what is important to understand is that business will go on as usual. We do not anticipate any change in terms of how the business will operate, the structures and so forth. So as far as Siloam is concerned, the whole VTO event really, has nothing to do with us. I mean, it is something that shareholders obviously want to do. But as with yourself, I mean, you will buy and sell shares. But what's important, I think, to highlight is that nothing will change in terms of how we run the business. The management structures will not be affected as well. I think as far as we're concerned, that's the main thing we can comment on.
Thank you very much, Pak Daniel and Bu Carol. Moving on to the second question from my chat box. Question from Ari. Number one. Could you share more on the color of brownfield expansion plans in the second half and 2025 after additional operational beds in first half? Second, is
Sorry,
there
Willie,
any?
can you repeat that question? I don't see it in
Sure.
the chat box, but can you repeat that question?
Sure, Bu. Question number one from Ari. Can you share more color on the brownfield expansion plans in the second half of 2024 and 2025 after the recent additional beds in the first half?
So I think that I've highlighted a few of the larger brownfield projects. Those are the main ones. So the one in Makassar, the ones then coming in Lippo Village, and also the ones coming Lubang, but although that one will be next year. Now, we continue to add beds in all of our hospitals. So just because it's not a brownfield project doesn't mean that we're adding beds. We are adding beds where we see the business growing. So we track the number of beds on several levels. One is our design capacity. There's a piece of land, this building that we have designed. Oftentimes we don't build to full capacity in the beginning because we may not need it for a few years. So there is a design capacity. There is a built capacity, whatever we've already built, and perhaps bare floors, whatever. And then the third one is operational capacity. And of course, number 4 is occupied beds. Now, if the occupied beds is coming close to our operational capacity, then that's easy. Then we will continue to add beds, and we will continue to bring the operational capacity up to build capacity. This is what we've been doing in MRCC. So even though you don't see MRCC as a brownfield, but we have added quite a number of beds in the past few months. Now, it is when then we come to our build capacity, then we need to build more beds, is then when you see it as a brownfield. So I think what to look forward to are the ones that I've already highlighted. But besides that, know that there are beds being added within the build capacity, which we don't highlight because it is a BAU. But of course, enabling us to drive volumes and drive our performance.
Just to add to what Caroline said, but we shared in the 1Q results as well. I mean, for those that weren't there, we are very excited. For example, one of the brownfield development is building the MRCCC oncology center, because we've always shared that the fact that MRCCC is a brand, not a locations. So there will be a
LV at Lipo
Sorry,
Village.
did I not say LV? Okay, yeah. So that will be built basically outside LV. There will be a new oncology centers with MRCCC branding. The focus is obviously continuing to build out our oncology capabilities. We do see that obviously the MRCCC is doing very well. The need for advanced oncology treatment is very strong. And we do want to build up this dedicated oncology one-stop stop center is basically right outside of LV. So that is one project that we were very excited as well in terms of a brownfield project.
Okay, thank you very much, Pak Daniel Bukerel. Another question from Ari also. Could you share the magnitude of further cost efficiencies and incremental EBITDA margin impact from your initiative that's shown before?
Maybe I'll take that one.
Yeah.
I think Carol has shared a very comprehensive list of initiatives that we're currently working on. Certainly, those are ongoing. All corporate insurance market, as we have mentioned that trend-wise, that is where Siloam is heading. Those are all the three factors that will help to improve margin over time.
Okay, thank you very much, Pak. Third question, how will the upcoming reclassification of segments affect your financials, and when will it start? Thank you.
Yeah, we're actually in the process of putting together numbers and quantifying. We will have a more comprehensive update in our next earnings call. It is the last year of our Siloam 5.0 strategy that has been very successful, so we would like to evaluate that. And we'll share our evaluation to you as a little bit of a closure as well for our Siloam 5.0 strategy. We will be sharing our new strategy, and of course, the reclassification of our hospitals or the archetype project will be a big part of our next 5 years with you. That's something to look forward to. Right now, the management is in the process of making sure that we really match our hospitals with the potential in the market, so we optimize every single hospital to what the opportunities are and what its potentials are. We'll come back to you in the next earnings call as we're in the process of quantifying that.
Just to add to what Carol has said, I'm just looking at the question itself. Keep in mind that this is not a financial exercise. Yeah, this is not about moving numbers around and putting them into different boxes. This really is a key anchor point of our next 5-year plan in figuring out what is the strategic directions for each hospitals to make sure that each hospitals has a clear design to cater for the need of the target segment that it will be serving. Right? So again, don't expect this to be a kind of look, all of a sudden we move numbers around, suddenly kind of margin improve by 20% the next quarter. I mean, this is not that kind of an exercise. It is strategic. It is what is going to be anchoring each of our hospital strategy over the next 5 years.
Okay. Thank you very much, Pak Daniel Bukerel. We have another question from Ingrid. Number one, how do you plan to acquire specialists in new facilities outside of Java workers? That's the first one.
Oh, okay. We want to answer that one first. Yeah.
Yeah.
Yeah. So, of course, when we are outside of Java, it is going to be more challenging. We do try to open in cities where there is a medical school there. So, for example, in Semarang and some other locations, there are cities that actually train and graduate specialists. And therefore, it is a little bit easier for us to recruit than if it was any other city. The next one is that we have been, for the past few years, investing in scholarships. So a lot of those scholarships that we've been investing in the last 4, 5, 6 years then we have graduates coming from the scholarships programs, and therefore we are able to deploy them to these cities. And of course, any city will have some specialists that we are also able to onboard. So with these three strategies combined, usually we're able to start with a good number.
Okay,
As you notice that we are also sticking to markets that are larger markets than we have been opening in the past. And so we believe that this challenge is maybe not as difficult as challenges when we were opening in, let's say, a Buton or a Lubuk Linggau.
Thank you very much, Bu. Next question from Ingrid also. What's driving the outpatient performance in the second quarter?
What is driving outpatient performance in the second quarter? I think nothing outside of what we have been sharing before. I think it's consistent building on clinical programs, and with that, referrals as well. There are a lot of referrals from out of town that do feed into our facilities. Our efforts in order also to work with corporates, insurances, are also initiatives that have kicked in, and also growing our outpatient performance in quarter 2 of 2024. Nothing new that we have done, but consistent execution of our strategy for Siloam 5.0 that is resulting in an uptick in volume in outpatient in 2020.
Okay, maybe let me take Aurelia's questions.
Yeah,
I just recap the questions a little bit as well. So Aurelia's been asking on whether we have any details on the capex for each hospital. Well, we don't disclose that specifically because obviously the capex requirement for each hospital is very different depending on the beds, the locations, the kind of type of hospitals we want to open, then the segment we want to look at. But previously we have guided the fact that look, the annual capex is about 1.5 to 2 trillion. So by that guidance has not changed. So in terms of our greenfield hospitals, would they also serve BBGS segments? I mean, definitely. I think but we've always been very open of the fact that BBGS is a key segment for us. So again, it depends on the type or archetype of the hospital that we're opening. But I would say a large majority of greenfield that you're looking at in here, I mean, will also be open to BBGS as well. The second question is from Aurelia in regard to the hospital property buybacks to First Street. Now, there's no further update on that, but we maintain the same position that over time, we do want to buy back more properties from First Street, and we have executed one in Surabaya. We do intend over time to execute more. Again, that needs to be balanced with the optimal deployment of CapEx. Beyond that, I have nothing further to add. For the Congo revenue contributions, is this driving more on OP or IP? Well, really, I guess if you want to, from the perspective of looking at revenue intensity, which is the questions, I mean, a lot of revenue intensity is going to come from inpatients, yeah. Outpatients is going to be more, if you like, it is the channel, it is the referral channel to go into IPD. So this Congo, in terms of revenue intensity, a lot of that would be centered upon the IPD rather than OPD.
Thank you very much, Pak Daniel. We have the next question from Sabrina. Number one, will there any further write down on this or selling of this asset?
There will be no further write down
Definitely.
in the foreseeable future.
Sure.
Look, some of the items that is obviously still in our books are basically buildings that we intend to develop. I mean, the strata in Bekasi, I mean, our Bekasi hospitals obviously is going to expand over time. So whatever you see in our books, basically that we haven't write down is what we do intend to develop. But I think I share with most of you in first quarters, when we looked at the write down, I mean, this is basically whatever was left over from 2019. So at these junctures, we are very clear about what is definitely going to go ahead. Whereas in 2019, there was some where, we were still not 100% sure. So those that we now are sure will not go ahead has been written down in Q1, and there will be no further write down for the foreseeable future.
I'll take the Samarinda one. Plan to resume Samarinda Hospital. Questions around why it was stopped the first time. I think the answer really is that wasn't the right location, wasn't the right facility. It was one that was flooded quite often. There were structural issues as well. We saw it as a patient safety and staff safety issue, and therefore we decided that it was not sustainable for us to continue, and therefore it was stopped. And so this time we have come in a much better location and a much larger facility as well. So we think that we can really optimize the opportunities in that market. Yeah.
Okay, thank you, Bu. We have another question from Ismail from Brits. Number one, could you share any particular reason of increasing salary cost in OPEX? Is it due to seasonality or allowance payment? And number two, will Strondol, Semarang, and Cipto be prioritized over the year?
Be privatized?
Prioritized, Bu.
Prioritized.
Yes.
Sorry, Willie, I'm not seeing the question. So
sorry, I have messaged you privately.
So whether it will be prioritized, I think that the list that we've shared with you is a short list. So that is a priority list. So if it is on that list, yes, it's going to be prioritized because we have done the analysis and we know that those are markets where we can be successful in. SWB cost. Well, keep in mind that that minimum wage increase is already at 8% year on year in Indonesia, and that is mainly what is driving the SWB cost. As we also continue to see volume increase, oftentimes in order to bridge the need of manpower, there is also overtime that gets increased as well. So those are the two main drivers of our SWB increase this year. We do track our productivity and sustainability of our SWB and our manpower. So for every single hospital, we see what is the ratio of outpatient visits to headcount, and we benchmark to all of our hospitals, and we also look at what the SWB portion is to our net core, and therefore we're able to monitor SWB and the number of headcount that we have in our hospitals.
Thank you very much, Carol. On to the next question from Ingrid again. Pak Daniel, do we have any impact from current situation of insurance company? Do we have any impact on Siloam performance on that?
We have a very close working relationship with our insurance partners. I mean, Carol may want to add to this. So obviously there has been various negotiations. I mean, that has happened in between us and the insurance companies. But I'm happy to report that, look, in most cases, we are able to reach I would say a situation whereby we are actually satisfied with, in regard to the final outcome. You can see that from the result that I shown before, that basically the mix in regard to the corporate insurance contributions has remained stable. You're seeing that the insurance portions of our market is continuing to grow. It is not shrinking.
Okay, thank you very much, Pak Daniel. Last question, Pak Bu, from the chat. Is there a target that ALOS in mind? If there is, what are we doing to get there?
I wouldn't look at ALOS as a whole. I think that on a consolidated level, on average length of stay, I think we are at a healthy level, given the mix, because we are not a network of all MRCCs, and we're not all a network of primary care providers either. And so I think the blended is very healthy, although I believe that the blended is very healthy, but what we should be looking at and what we track as a management team is average length of stay for certain procedures. So for example, we used to keep cabbage patients or open heart bypass patients for 7 days in our hospital. Now that 7 days has come to 3 days. It has come to 5 days, which is the benchmark. Now, best in class, we can come down a little bit more. But while we are also bringing down the average length of stay on certain procedures, if the level of complexity of our procedures goes up, then we will also be having patients with long stay. So we have some tailwinds, we have some headwinds for average length of stay. I wouldn't be so concerned about the A loss on a consolidated level, but what we're doing is optimizing average length of stay for individual procedures where we know that by reducing average length of stay, then it's a reduced cost to patient and also better outcomes for our patients as well. What we have been able to do is, that is quite unique with Siloam, is to create a seamless clinical pathway for certain procedures, bringing in home care. So for example, we have been able to reduce our length of stay for transplant patients by discharging them earlier, but making sure that our home care teams go out to make sure they do their wound care, to make sure they do their therapy and so forth and so forth. And so that is a very unique way that we're able to reduce length of stay and optimize outcomes in individual procedures. But on a consolidated level, it is at a good place.
Okay, thank you very much, Bu Carol and Pa Daniel. As we have no more questions, we can conclude our call for today. So again, thank you, Bu Carol and Pa Daniel, for your time. We'd also like to thank you to all participants who joined the call today. And if you have any follow-up questions, please feel free to reach out IR Investor Relations Support anytime. And we'll see you on the next webinar. Thank you very much, all, and
Thank
have
you,
a good day.
Have a
Thank
good
you,
day.
everyone. Right.
Recording stopped.